Hey everyone, I'm Jeremy Szafron. This is Kitco News. Well, oil prices have been closely linked to the global economy, especially as geopolitical tensions flare up in the Middle East. With the recent escalation between Israel and Hamas, the focus has shifted to potential disruptions in the region, including a possible retaliatory strike from Israel on Iranian oil assets. Now, this would significantly impact global supply, and it could send prices soaring even higher. While we've already seen price spikes, the questions remain about whether the market can handle a larger supply shock, especially with key OPEC plus nations holding substantial spare capacity. At the same time, global economic growth is showing signs of slowing, with China's economy expanding at its weakest pace in 6 quarters, despite continued stimulus efforts from the central bank. Now, consumer spending has picked up, but challenges in the property sector persist, leaving uncertainty about the long-term trajectory of the Chinese market. As we face this mix of geopolitical uncertainty and shifting economic forces, we're joined by Roukaya Ibrahim. She's the strategist of commodity and energy strategy at BCA Research to break it all down. Roukaya, thanks for being with us today.
Thanks for having me on, Jeremy.
Yeah, I appreciate your time on this. I mean, obviously, I mentioned off the top, there's so much to get to, but let's start with oil prices. I mean, they've been long tied to the health of the global economy, obviously acting as an indicator of inflation. You know, we got energy costs, the broader economic conditions. But often on this show, I cover oil, and it's not as flashy as a topic, so some viewers don't quite get it. But I wanted you to kind of explain and start by explaining why oil prices play such a critical role in determining the state of the global economy.
Right. I mean, what's been happening in oil markets is extremely interesting over the past year. You know, we've seen a lot of fluctuation, but they've really been in this trading range. It's been in this trading range because of, we're seeing on the one hand, the geopolitical risks that you highlight that are potentially could disrupt supply. And on the other hand, we're seeing a demand slowdown in oil. Now, of course, demand dynamics feed into oil prices, but it also goes the other way around. As consumers, oil goes into, a lot of what we consume. And so whenever there's an increase in oil prices, gasoline prices, that is definitely felt by consumers. It trickles through to the consumer in the form of inflation. And so it definitely has a really big impact on the overall economy, as well as the other feed through as well.
Yeah, well said. And I mean, we've certainly seen some sticky inflation this year. To your point, let's talk about those prices. I mean, WTI crude oil has seen significant volatility this year. It's ranged from a low of $64 a barrel in May to a high of $93 in September. And then in recent weeks, it has dropped from 85 to 69. It's about a 20% decline amid these geopolitical tensions, particularly, as I mentioned, this Israel-Hamas conflict and fears of Iranian retaliation. So Brent crude has kind of similarly fluctuated. Given these large price ranges, Roukaya, are we witnessing real supply-demand shifts, or is it more of a short-term geopolitical fear that's primarily behind these prices?
I think there's a lot going on in oil markets, and this sort of volatility in the trading range. In the case you mentioned, this range for WTI in the case of Brent, it's been pretty much moving in the range of $75 a barrel to $90 a barrel for a year now, pretty much. We recently saw a breakdown below that in September, but it's kind of now at the very bottom of that range. And I think what's going on is really a lot of both near-term risks as well as cyclical risks that are affecting oil markets. And if you start off, for example, with demand, and I think that's really the reason why we've seen a lid on prices, that even though OPEC Plus has cut supply. The current cuts are 5.8 million barrels a day, nearly 6% of global consumption. Even though we've seen those supply cuts, that really hasn't translated to an increase in oil prices. And the reason for that is we're seeing demand deteriorating. In the first half of the year, global demand growth was at its slowest pace since the pandemic. It slowed even further so far in the second half of the year. And we're seeing the EIA, the IEA, as well as OPEC continuously revise down their demand forecasts over the past few months. So this is a cyclical concern. It highlights, weakness in China, which you mentioned. It highlights as well weakness in developed markets in terms of their oil consumption. So that's really put a lid on, how far oil prices can go. And it's highlighted that if the OPEC coalition wants oil prices to move higher, they're most likely going to have to cut more. So, it brings into the conversation the supply side of oil, which of course there's a lot going on there, which, as you mentioned, with what's happening in the Middle East, as well as, trying to understand what is the end goal for OPEC and how are they going to respond to the markets.
Right. Yeah. As you mentioned, I mean, the conflict in the Middle East is threatening oil supplies, particularly with Israel potentially targeting these Iranian oil facilities. Hypothetically, Roukaya, if that happens, what kind of an impact could we see on the global oil supply? And could OPEC Plus step in to offset this somehow?
Yeah, it really depends on what kind of supply disruption that we get. And, what's really interesting is what we saw in September with the oil prices coming down below that, 75 floor that we saw since the beginning of the year for Brent, that occurred amidst, demand side concern. But it really, at that point, the sort of consensus in the oil market was extremely bearish that they sort of overlooked the supply shock. And then we got the news that there was an escalation in the Middle East. It's now nearing regions, geographies that are very relevant when it comes to oil markets. It's now nearing things like, Iran is getting more actively involved in this conflict. So, we saw the as you mentioned, the news that, the possibility of hitting Iranian facilities, which in this case, it depends on what they hit. But Iran has been exporting on average 1.7 million barrels a day of oil, crude oil, so far this year. That sounds like a lot, which it is, but we also have to put this in context of OPEC spare capacity. So OPEC plus spare capacity can easily offset that. As I mentioned, they've cut oil production by 5.8 million barrels a day. And so there's plenty of available supply that can come on the market to offset something like that. And so in that event, I think that prices will respond to a supply disruption, but I think it would most likely be a short-lived one. Now, what would really impact oil prices is if we see a more massive disruption. So something like, a blockade on the Strait of Hormuz, a shutdown of the Strait of Hormuz, through which a fifth of global crude transits. In that case, the supply that's coming out of the Gulf, where most of the spare capacity is located, is not going to be able to reach global markets. And that would lead to a much more significant spike in oil prices.
Yeah, interesting. But are investors overlooking how long it might actually take for OPEC Plus to bring more oil online if Iran's supply is disrupted? I mean, it seems like it won't be overnight.
What's really interesting is what we saw in the last sort of pretty big oil shock back in 2019 when the Saudi Aramco facilities were hit, the Abqaiq and Khurais refinery facilities were hit. That led to a spike in prices, but they were easily able to bring that back and quite quickly, actually. And so the price spike was really short-lived. And I think that highlights that, producers are able to respond quite quickly. Right now, especially since, they already have the capacity that's available. And so I think that it is possible that, as I said, we'll probably see a response in terms of prices, but I think it's probably going to be a short-lived one unless we get a really massive supply shock.
Interesting. Okay, well, Roukaya, let's switch over to the U.S. I mean, production remains robust. It's growing by nearly 2.5 million barrels per day during recent years. And there's conflicting information about how U.S. energy independence has really evolved under the Biden administration. I mean, with debates about the impact of his policies, such as the cancellation of the Keystone XL pipeline on his first day in office. In the context of these mixed signals that we're getting, I mean, how much should we expect the U.S. to fill any potential gaps here?
Well, actually, what's interesting is, part of the reason why oil prices have been relatively subdued so far this year is because we're seeing the supply growth from the U.S. And actually supply growth from other places as well, non-OPEC countries, Canada, Guyana, Brazil. They've sort of offset the production cutoff that we got from OPEC. Going forward, I think that U.S. producers are going to respond to what happens to markets. They're not going to pump at any cost, but if prices are high enough for them to be profitable, they're going to continue to grow their output. I think that what this means is that production is going to increase, but not at the same rate that it increased, for example, last year. I think production growth has already slowed down this year. It's not going to reaccelerate. But unless we see sort of a breakdown in prices, at which point, their profitability will be hit. We're not likely going to see sort of a decline in U.S. output. It's already reached record highs under Biden administration.
Right.
And so I think that, going forward, that's likely going to continue.
Yeah, I mean, it does bring the question because it's been a crazy year. I can't believe we're just about to go into more political coverage here. But as we look towards the 2024 U.S. election, there are significant policy contrasts between Biden's renewable energy focus and Trump's drill, baby, drill approach. So should we anticipate that a change in administration could drastically impact U.S. oil production and prices? And if so, how soon would those take effect?
I mean, unless we get a blue sweep results in the U.S., I don't think that there's going to be a drastic change in the outlook for U.S. oil production. So, in the case, and a blue sweep is not the base case for us at BCA Research. So I think our base case is that the U.S. oil producers, are just going to be responsive to market conditions. They're not going to they still have to ensure that they return enough cash to shareholders. And so they're not going to be producing at any cost. But at the same time, they're going to be, as long as prices are profitable, they're going to continue to grow output.
Yeah, I want to switch over a little bit to China here. I mean, it's one of the world's largest oil consumers, and it's seen its economy really slow dramatically here with growth at its weakest level in 6 quarters. So how does, China's slowdown impact these global oil prices?
Yeah, the EIA, IEA, OPEC, they have all cited China as one of the reasons why they're downgrading their oil demand forecasts for this year. And Chinese oil consumption, has contracted so far this year. Their oil imports are contracting. And so unless we see a really robust reacceleration in the Chinese economy that leads to an improvement in their demand, we're unlikely to see sort of this headwind on oil fade. So our expectation, policymakers are already starting to roll out stimulus, but the stimulus that we've seen so far is not really enough for us to change our view over the coming 6 months about the Chinese economy. Typically, stimulus acts with a lag, and what we've seen so far is not really anything too drastic that's going to change the trajectory for the economy. So, I think that the Chinese economy is probably going to remain a headwind for oil over the coming months.
Yeah, it's been fascinating to watch. I mean, as you just mentioned, China recently announced a fresh round of stimulus measures, and it's really kind of aimed at supporting its faltering economy. I mean, the PBOC, the central bank, has injected some liquidity into the capital markets. This came alongside China's economy only growing by 4.6% in Q3. It's the slowest pace, like I mentioned, in 6 quarters. Roukaya, it's just not enough stimulus here to really make an effect. Is that what I'm hearing? I mean, with China being one of the largest oil importers, could their economic struggles offset these price spikes driven by the geopolitical tensions, or will the Middle East tensions continue to dominate the market on the oil side?
I think what we're going to see in terms of oil is that we're going to see a continuation in volatility because the cyclical trajectory for the economy, whether that's China or even Europe, and the U.S. economy is also showing some signs of a slowdown, we expect it to head to a recession over a 12-month horizon. So I think the trajectory on the demand side is to the downside, but we see, of course, that there are still tensions in the Middle East that persist, and that could lead to spikes. So we're going to see a lot of volatility in oil prices. But unless we really do see a major supply disruption, I think that the path for oil prices over a longer term, like let's say 6 to 12 month or 6 to 9 month horizon, is to the downside.
Interesting. Okay, so it's due to the downside. But in this volatile market on the oil side, I mean, where do investors make money? What's the trade here?
Yeah, I think that the trade in terms of commodities is gold. I think that, gold it benefits from the macroeconomic outlook. It benefits from central banks cutting rates. It benefits from central banks trying to prop up their reserves with gold, increase the share of gold in their reserves. So in terms of commodities, I think gold is where is best suited to benefit from the outlook. Not only oil's not the only commodity that is affected. Actually, the commodities that are most affected by the Chinese economy are industrial metals, things like copper, iron ore, steel. And unless we see stimulus that translates to an improvement in demand from the real economy that leads to an improvement in commodity demand, not just stimulus that boosts investor sentiment, the these metals are going demand for these metals is going to weaken. In many cases across metals, China accounts for around 60% of global demand of the metals. And so, unless we see an improvement in the property sector, in infrastructure construction activity, those types of things, the metals are not going to do so well.
Yeah, well said. I mean, it's been quite fascinating to watch, obviously, this year. And just recently, I think just a couple of days ago, December futures hit a new record high, past that 27.30 mark. Spot gold, again, new all-time highs. Meanwhile, silver has jumped between, 32, 30, 33 an ounce, largely outperforming gold. Obviously, it's got those dual industrial uses. What's your broader outlook here in terms of those two metals before we get into copper?
Yeah, I mean, in terms of gold, I think that what's really interesting about gold is that it's kind of broken down over the past 2 years from its traditional relationship with financial variables, and namely real interest rates in the US. And this breakdown, I think, highlights that there's this new support coming from central bank demand, because central banks have seen what has happened to Russian reserves, Russian US dollar reserves, following the Ukraine invasion. And, these emerging market central banks are trying to diversify their reserves and reduce their exposure to US dollar assets. So I think that this is going to continue to support gold because it's a strategic sort of tailwind to gold. It's not only the PBOC, but we've also seen the Central Bank of Poland, the governor of the Central Bank of Poland, as well as India's central bank governor, explicitly state that they want to increase the share of gold in their reserves. And in addition to that, the cyclical environment, as I mentioned, we are bearish on the economic outlook over a 12-month horizon, and gold typically outperforms other commodities whenever there is weakness in the economy. So when the economy is not doing well, gold still continues to do well. And so that sort of cyclical environment, alongside further rate cuts from central banks, I think will continue to provide a tailwind for gold. Now, the interesting thing about silver is that silver benefits from similar tailwinds as gold, as well as industrial uses. And I think that industrial demand component makes silver more vulnerable over a cyclical time frame, because if we do see a deterioration in the manufacturing sector, that would have a bigger hit on silver than gold.
Yeah, no, it makes sense, particularly, in China, too, as we talk about it. I mean, the consumer spending has shown only marginal improvement despite recent stimulus efforts. In September, retail sales grew 3.2%, up from 2.1% in August, supported by government subsidies for items like appliances and autos. But then when you look at the broader consumer demand, it remains weak, particularly in the property market, which continues to drag on economic recovery. Obviously, Roukaya, this sluggish growth has raised questions about whether China's stimulus measures will be sufficient to ignite the economy in some significant way there. But what's your take here? I mean, what does this mean for industrial metals? I mean, we talked about copper there. What does this mean in the long term?
Yeah, I think what this means is that in order to see a real sustained improvement in demand for copper from China, we would need to see these sectors that have been troubled for the past couple of years improve. So, the property sector, we would have to see measures that will lead to an improvement in construction activity, not only, a stabilization in home prices, but also an improvement in construction activity that will lead to greater demand for copper. You mentioned retail sales and sort of, they were boosted by these white goods, but that's like sort of a one-time scenario due to policies that they've already enacted to support this demand for appliances. In order to see a continuation in that would feed into a commodity demand, we'd need to see, again, consumer spending recover, consumer sentiment recover, and demand for these white goods are often tied with what's happening with the property market. People buy houses and then they buy the appliances to fill them with it. And so we need to see that sort of take shape in China in order to turn more bullish on the outlook for industrial metals. So until we do see that, until we see enough stimulus to impact that demand, I think that there's going to be continued headwinds for copper prices over a cyclical horizon. Now, over a longer term horizon, I think that there are forces that support copper prices over a multi-year horizon, but this is over more of a six month horizon. There is still some headwinds.
Right. Okay. So that volatile market, I mean, given all the volatility across oil, metals, like we just talked about, and then, of course, there's other commodities. I mean, what's BCA's current strategy here? Are you advising clients to take a cautious approach, or are there opportunities to capitalize on this instability?
Well, I think in terms of how to position a commodity portfolio, as I mentioned, I think oil is going to remain quite volatile. But ultimately, over a 12-month horizon, as demand deteriorates, I think oil prices are most likely going to weaken further. So it's not necessarily we're not necessarily at the point where we would initiate a short position in oil, but I think that we investors should be looking for a spike in prices on the back of a supply disruption that maybe is not massive enough to be sustained, and that would be an opportunity to short oil. And so I think that investors should be on the lookout for that. Really, where we are most optimistic is, as I mentioned, on the outlook for gold. And we're really watching what's happening in terms of the policy developments, the economic developments in China to see, at what point will are we going to be confident in calling a bottom in industrial metals and, looking for an opportunity to gain more exposure to them, over a cyclical horizon?
Yeah, interesting. Looking for the dip, looking to buy the dip. Okay, well, I mean, it's fascinating. And obviously in this world, news goes so fast that we'll be keeping an eye on the Middle East and the developments there. Roukaya Ibrahim is a strategist of commodity and energy strategy at BCA Research, joining us from Montreal. Thanks for this, Roukaya. I really appreciate your time today.
Thanks a lot, Jeremy. It was really great talking to you.
You as well. I appreciate it. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for watching. We got great content coming up all week long and a continuation next week. Enjoy your time. We'll see you next time.